This is On The Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
Information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On The Charts podcast, episode 205 for Tuesday, 30th of May 2017. US markets were closed last night, but on Friday they traded in an extremely tight range, the 8th smallest range seen since 1990. It was also the lowest traded volume for the year. It appears again, without much economic data and a long weekend that was ahead, investors were intent to sit and wait on the sidelines. A Federal Reserve member stated that the US and the rest of the world were on different pages when it came to direction of interest rates, and oil prices recovered some of Thursday's losses, adding 2% on Friday. China was closed today, and in Australia the market initially followed through from yesterday's weak performance and slipped below the 5,700 level, which is the lowest point in the last 2 months. Quite frankly, 5,700 is nothing more than a random round number and has no technical bearing whatsoever. 5,600 on the other hand has significantly more technical relevance, as it's a line of support extending back to July last year, and also the target price for a bearish pattern that's been in place since early May. The main culprits are the heavily weighted banks and financial, which are down some 10% this month alone. ANZ leads the pack, slipping 15%, and technically there's no suggestion of any reversal or fortune anytime soon. Over the last 18 months, the All Ordinaries has returned just 10.5%, of which some 8.5% has come from dividends. To put that another way, over the last 15 months, the Australian share market has advanced in growth just 1.5%. In other news today, Altair Asset Management decided to liquidate all its Australian share funds and return assets to clients. It cites, and I quote, impending property market calamity and the overvalued and dangerous time in the cycle. NIB lost 5% today after the ACCC announced it was taking the health insurer to court for misleading its members. And overall, the ASX lost about 20 points in early trade, then made its way higher throughout the afternoon, closing about 0.2% up on the day. Banks especially rejected early weakness, finishing mostly about 1% higher. And Audio Pixels jumped late in the day. I'm not quite sure why, but closed 17% up. Telstra lost 0.7%, and apart from the financials, most sectors closed down on the day. A few stocks of interest today, starting with Webjet, that recently reported an almost 100% jump in half-year earnings. The online bookings and travel agency was established in 1998 and has consistently been at the forefront of online innovation, from travel services aggregation to more recent blockchain innovation. It established WebBeds, a business-to-business travel agency, in 2013 and has positioned itself for continued strong earnings growth throughout 2018 and 19. Now, technically, the stock looks very strong. In late 2016, the share price dropped some 30% and has been grinding its way higher ever since. The pattern at hand is known as a cup and handle base and tends to resolve itself in the direction of the longer-term trend, in this instance up. The measured move, should the stock break to new highs, is $15, maybe slightly above, which compares favourably to its $11.80 close today. Importantly, a low-risk opportunity is now available, and we've highlighted that for members in the ASX Power Setup service tonight. At the small end of town is Zenith IP Group, which added 2% today, closing at 206. The company is a holding company or a holding group for entities providing a broad range of intellectual property services and advice, and is the second largest IP player in Australia. It operates under various brands: Griffith Hack, Shelston IP, Watermark, and Glasshouse Advisory. It employs about 400 staff across Australia, New Zealand, and Asia, and first half earnings were ahead of forecast after a suite of recent acquisitions and integrations. The industry outlook is positive, based on further extensions in the Asian market and leveraging off international clientele. Now, technically, the share price has been in a steady downtrend since early 2016, when back then it was trading at $4. So far in 2017, the downside momentum has halted, and we're seeing what appears to be a basing formation take shape. The upper side of that base is $2.25, and whilst we're not seeing an intermediate attempt to break out, it's certainly worth watching the stock's progress over the coming month. Base breakouts tend to reverse prior trends and can offer a signal for a renewed trend in the opposite direction. So there's scope here for the industry to consolidate, and Zenith could be well placed to take advantage. Thanks for listening to On the Charts. If you enjoy my daily update, it'd be great if you could write an honest review and give us a rating on iTunes. Good reviews mean we reach a wider audience, and you'll encourage us to keep producing this free podcast. Thanks for listening, and I'll see you on the charts tomorrow.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.